Self-employment tax is not just another name for income tax. It generally refers to Social Security and Medicare taxes for people who work for themselves. It is one reason contractor income can feel very different from a paycheck. This video explains the 15.3% number, why gross revenue is the wrong starting point, and how self-employment tax fits into the complete return. My name is Mitch Caldwell, your modern-day tax CPA, and I am a licensed CPA here in California. This is general tax education, not individualized tax, legal, accounting, or financial advice. The calculation depends on net earnings, wages, filing status, and other facts. Employees generally see their share of Social Security and Medicare taxes withheld through payroll. Employers generally pay an employer share as well. When you work for yourself, self-employment tax is generally calculated through Schedule SE rather than withheld from each client payment. The Social Security and Medicare programs are familiar, but the payment workflow is different. If you want tax explanations that show the calculation instead of repeating one scary percentage, subscribe to Modern Day Tax CPA. The self-employment tax rate is 15.3%. That consists of 12.4% for Social Security and 2.9% for Medicare. But multiplying every client deposit by 15.3% is not the complete calculation. Schedule SE generally applies the calculation to net earnings from self-employment. For a typical Schedule C business, the computation generally starts with net profit and applies the Schedule SE rules, including the net earnings adjustment. W-2 wages can interact with the Social Security portion because the applicable wage limit considers combined wages and self-employment earnings. Additional Medicare tax may also apply above statutory thresholds. That is another reason the basic 15.3% headline is not the entire federal result. Suppose clients pay a business $10,000. That is business revenue. If the business has $2,000 of legitimate deductible expenses, Schedule C net profits may be $8,000 before considering other tax-specific adjustments. Self-employment tax is generally connected to net earnings, not simply the $10,000 that entered the bank account. That is why bookkeeping matters. Without complete income and expense records, even the starting business number may be unreliable. In a simplified example with no wages and no special rules, Schedule SC generally applies a 92.35% adjustment to Schedule C profits before the basic self-employment tax rate is applied. Using the $8,000 profit example, 92.35% is $7,388 of net earnings. Applying 15.3% produces approximately $1,130 of self-employment tax before considering other interactions. That example is deliberately simplified. Wages, the Social Security wage limit, additional Medicare tax, special occupations, and other Schedule SE rules can change the result. Under the general rule, Schedule SE is required when net earnings from self-employment are $400 or more, excluding the separate church employee rule. That is a net earnings threshold, not a rule saying the first $400 of contractor revenue is automatically tax-free. Special rules can apply to particular activities and workers, so the business facts still matter. Also remember that the broad 1099 family includes forms reporting many kinds of payments. The fact that income appears somewhere on a 1099 does not by itself answer whether that income is net earnings from self-employment. Self-employment tax and federal income tax are separate calculations. A self-employed person may owe both. Income tax depends on the complete return, including other income, deductions, credits, and filing status. Estimated payments can be used to pay towards income tax and self-employment tax during the year. State payments may be a separate requirement. The federal return generally allows an adjustment for the employer equivalent portion of self-employment tax when calculating adjusted gross income. That deduction affects the income tax calculation. It does not erase self-employment tax or reduce net earnings from self-employment. Think of it as a separate adjustment within the complete return, not a refund of the tax just calculated. Next are the 5 most common mistakes I see. Mistake number 1 is treating self-employment tax as income tax. Mistake number 2 is calculating from gross revenue without considering legitimate business expenses and the Schedule SE rules. Mistake 3 is assuming every 1099 automatically proves self-employment tax treatment. Mistake 4 is ignoring estimated payments and state tax planning. Mistake 5 is comparing contractor revenue directly with employee take-home pay. The practical system is to track income, document expenses, review net profit during the year, estimate the complete tax picture, and preserve every payment confirmation. So the plain English answer is this. Self-employment tax generally funds Social Security and Medicare for people working for themselves. It is separate from income tax and generally relates to net earnings rather than gross income. Next, watch the side hustle tax checklist because these rules become much easier when the records and payment system exist before tax season.